A lot of people think they're going to make money with strategy. A strategy is number one. But if you don't have the structure for the strategy, you cannot grow that well. That's what I have done since 2009. It's been extremely successful through all kinds of markets, up and down, COVID, all this. We've done extremely well because is the best structure in my opinion and my experience. And I've been in the education business for 25 years. My company we have thousands of success stories on YouTube.
Cherif, thank you for coming on the show today. This is going to be an interesting conversation, I think. I think comparing between debt funds and equity funds and really breaking it down, how these tools can be utilized in this market is going to be pretty interesting. So thank you for taking the time today.
Absolutely, my pleasure. Thank you for having me.
So why don't you give us like a 30-second deep dive into, I know you're the CEO and founder of Medawar International Group, and why don't you tell us about the funds that you have?
Okay, great. So I have been in the real estate fund business for 17 years. I've been teaching that as well in my educational events. And I started my own fund in 2009. So it's been 15 years plus almost now. And maybe I can define a couple terms because
Sure.
people get lost in the definition, first of all. So when you raise capital to deploy it, you're under the watchful eyes of the Securities and Exchange Commission. And the SEC, for the acronym of Securities and Exchange Commission, is the government organization that kind of oversees these activities. And they want any individual who's going to raise money from a group of people and will actually get into an endeavor with the intention of making profit and making all the decisions for them. They consider that a security, and they want that individual or those individuals to actually set up what's called the private placement memorandum and file with the government, with the SEC. So there is sec.gov. Somebody tells you I have a fund, you can go to sec.gov, you can check out their name, the name of their entity, and you can see if they're registered or they're filed. Meaning filed is for private funds. Like you can say, hey, I'm Joe Killinger, I want to do this tomorrow. And you start the paperwork, you write a business plan, you talk to an SEC attorney, and for about $35,000 to some crazy numbers, I've seen people charge $70,000. Yet they can actually draft a private placement memorandum based on your plan, your business plan, what you're gonna, who are you gonna be with, maybe with your partner, what kind of products you're gonna buy or projects you're gonna get into. I mean, am I buying apartment buildings? Am I buying single tenant? What are you gonna do? And then what positioning you have? How different are you in the market? Why would people want to invest with you? And then what kind of performance you're gonna do when they give you the money? What are you gonna do with the money? Oh, we're gonna buy apartment building, convert them to this. We're gonna buy hotels and convert them to apartment buildings. We're gonna do storage facilities. And then finally is how are you gonna pay out? How are you gonna do the profit splits? And that's where the important part is going to be. Can you pay these realistically? Are you over-promising, under-delivering? Is it an equity fund or an actual debt fund? So now we defined what is security, which is an individual taking money from groups of people, making the decisions on his or her own. That's a security. That's EC says, okay, now you're under the exemption rules. You don't have to register. You don't have to go public. We'll give you an exemption. You don't have to register, but you got to file with us. So that's called a filing. An attorney that specializes in this field will help you draft the documents, help you put all the disclaimers and disclosures, because this is not buyers beware, this is full disclosure. And you can be a syndication, which is raising money for one asset, whereby you say, we're going to buy 123 El Camino Real apartment building. So you're raising money for that. And you say, we're going to pay cash flow 5%. And then on year 5, we intend to sell the property with an upside gain of so much. And we're going to give you 70% as investors of the gain. And we're going to keep 30% as syndicators. That's one business model. That's called an equity fund, because they're going to make some equity.
Okay.
You can have some problems. The market may not work to your advantage. Interest rate increases. You don't get the numbers you promised. You may lose money. And they're in equity position. These investors will lose some money with you. SEC will say, did you put that in your private placement memorandum? The PPM is the private placement. Did you tell them we're going to invest in this address, this property, we're going to do this, we're going to do that, and there is a chance for loss? If you did, and you did everything in good faith, no negligence, no ill will, etc., well, that's whatever the outcome is going to be. And these investors may want to invest with you again. You can do another syndication, set up one for another asset. Or you can set up what I like to set up, what I recommend for people, because we can help people set up. And what is called a real estate fund. A fund is like a mutual fund. Instead of investing in one stock, one company, IBM or Facebook, you can actually invest in a mutual fund or like in a basket of assets. That's what I have done since 2009. It's been extremely successful through all kinds of markets, up and down, COVID, all this. We've done extremely well because a debt fund is the best structure in my opinion and my experience. And I've been in the education business for 25 years. My company we have thousands of success stories on YouTube. Okay. The reason I tell you this is because you can then say, we're going to set up a fund. You can invest with us and we're going to give you, this is a debt fund. We're going to give you a fixed return, 6% if you invest so much. You want to invest more, we'll give you 8%. You're going to invest over $1 million, we can give you maybe even 10%. And you can tell them, I'm going to invest in these type of assets. We're going to look at single tenant buildings that have these type of opportunities. We're going to invest in apartment buildings that have this type of positioning. We're going to do these type of developments from the ground up. And we're going to do it throughout the United States and US territories. Now we have people that can invest from as little as 25,000, for instance, up to millions of dollars. And like I can tell you the structure I like, from 25,000 to 250,000, they get 6% per year. You have a lot of people sitting with IRA, self-directed IRA money, they're not making a penny. So for them getting 6%, you do the payouts, let's say once every 6 months. So 6% is a 3% and then 3% every 6 months. So they can even compound the money. But at 250,000 to millions, I'll pay you 8%. Now that structure helped me a lot. I mean, from 2009 till now, I've been set up like this and we have over 100 million in assets. And we do very well. And a lot of our investors love the steadiness of the returns. We charge, for example, I suggest for funds to tell investors, I'll charge you no acquisition fee, no management fee, no disposition fee. Why? Because all the upside can become yours. And when you set up a debt fund, they're not stuck for 5 or 7 years. They give you the money, they're investors, but they're really creditors. They start accruing the interest right away, but you deploy the capital with some money from the banks, maybe some credit lines for rehab, your positioning, etc. You're making cash flow, you're paying them, and the rest is yours. You sell it 5 years later, 3 years later, you do whatever you want, it's yours. You earn that, you paid them, they're happy with the 8% they're getting with no hassles, and they can withdraw the money. I tell these investors you can withdraw with a 12 months notice.
Okay, 12 months notice. I was wondering if there was a minimum that you could do, yeah.
12 months, and you can cash them out within the 12 months.
Okay.
And you get the full principal plus accrued interest at any time. This gives them the steadiness of the income. This is such a big deal right now for baby boomers retiring. They want higher income. They don't want that risk of what's going to happen 5 years from now with your apartment building. And look at what's happening now. Interest rate went up in 2022, a couple of years ago, and these people are not having the same exit. But because I pay 6 and 8, and for people that put extra money, we give them a special class of shares and pay them a little bit more. I've been able to pay them with no problems. I invest in San Francisco, rehab, luxury homes. These are millions of dollar homes. We do development in Florida from the ground up. Okay. We do mixed use commercial in Puerto Rico. And that's what you can put in a real estate fund. Okay. And people can come in, can ask for the money back out, and you can pay them back as you refinance or as you grow. Now, in equity fund, you must sell. 5 years later, whatever period of time, you have to sell. And the upside, you have to give them from the gains. But in a debt fund, you can own that apartment building. You can reposition it. You can refinance and cash them out if you want, but you keep the asset. It stays in your family forever. It's a legacy. And they're happy. They don't want to cash out. I've cashed out some gentleman who had 400,000 from his IRA. And a couple of weeks later, he left me a voicemail message. He said, Cherif, I don't know what I did. What am I going to do with this money? Can I go back in?
Yeah, that was going to be my question. Can you take your IRA and invest in these then?
Yes,
so
absolutely.
Can.
Yes, absolutely. Okay. Self-directed IRAs, because actually the IRA companies, they love these debt funds because you send them the private placement and there is the qualification questionnaire. An investor that wants to invest will get the private placement, which is the full disclosure. We're going to do this, this, this. And then it has the qualification questionnaire. They fill out the Susie Johnson, I'm an engineer, I make so much per year, etc.
Sure.
And then she fills out a subscription agreement. And when she fills out all this, you approve it. And then you give them a promissory note. So the IRA gets the promissory note. If it's an investor who put the money into your fund through the IRA account, you're paying the IRA. And they can even reinvest the money. 8% reinvested because it's compounding every 6 months.
Yep.
In 10 years, the annual rate of return becomes 12%. Listen to this. If they keep it another 10 years, so 19.2 years or so, it's like 20% per year average rate of return, because it truly does compound at 8%, and it's paid semi-annually, 4%, 4%. And they can take a calculator and do it. And my funds have been up and running since 2009. I've had tremendous success stories with people.
I can imagine. Now, are you seeing, I would imagine right now you're getting a lot more people knocking on your door for your debt funds, aren't they?
Yeah, it's funny. I've been pitching these funds, and I've been saying, and they would say, oh, I want to go to these apartment building syndication one at a time. And I say, but your risk is lower to invest in a fund that has all these assets. Your 25,000 or 250,000 is cross-collateralized against all this. But then they were lured by potential higher returns. And guess what happens? You may make high return one time. Next time you may lose some. You'll have a capital call. A capital call is when the investor, the syndicator, says something like, we have roof damage. The insurance has a high deduction. We don't have enough capital on the side. We need to do a capital call. All the investors got to put money. In a debt fund, you don't do that because you're paying less. You're able to control your process of cash flow better. You have some properties that you rehab and cash out. That's why you're able to cash out investors sooner if they need to. Yep. So let me also explain another term, if I may. There are two types of investors. There is what's called accredited investors, those with a net worth of $1 million.
Yep.
And there is the non-accredited investors that are sophisticated, those with a net worth less than $1 million. That net worth of $1 million must exclude their primary residence. So the SEC says, if you want to take accredited investors, this is what we prefer. And those are the people who have a net worth of $1 million, excluding their home, or, I said or, not and, but or they make $200,000 per year gross income if they're single, or $300,000 if they're a couple. Now, there are plenty of people making that type of income or having that net worth, and they are busy in their profession. So they look for people like you who are experts in real estate, like you're a broker. I've been in the business for 40 years. We know what we're doing. So they look for somebody who set up these type of syndications or real estate funds, and they want to go in, and it's up to the investors to decide, do I want the steady income that I can compound or maybe live off that cash flow, or do I want to take a little bit more of a risk and equity, maybe more on the upside, take some risk on the downside. And then there are two types of regulations under the SEC. Can I go into that? I'm sorry, I'm defining so many terms.
No, I'm listening.
Okay. There are two types of setups. There is the old structure called Reg D, which is Regulation D 506B, which allows you to raise capital from friends and family. You cannot publicly advertise your fund, but you can raise it from friends, clients that you've had, people that know you and you know them, and you can take up to 35 non-accredited people. So now you can go to your cousin, you can go to a colleague at work, you can go to an employee of yours, you can go to some old friend that you've had, a neighbor, and they're not accredited. They don't have a high net worth or high income, but they want to invest. They like this. It's real estate, steady income, there is insurance. It's a lot safer for them than other type of investments. So you can set up this if you have enough friends and family that you can actually raise capital from them and pay them and have them continue their profession, do whatever, but you're working their money and you're paying them or you're compounding their returns. Then into this regulation, Reg D 506B, was since 1933. It was set up. In 2015, Obama, when he was president, he came up with something incredibly great. I don't think he gets enough credit for it. What he did is the Jobs Act. He convinced the SEC, he said, listen, the country's not doing well. We need to allow these real estate private fund managers that raise money and they file with the SEC, etc. We need to allow them to publicly solicit so we can get more money in the real estate, which creates bonanza in the country. Mm-hmm. So they rolled out Reg D 506C, which allows anybody to set up a real estate fund and publicly solicit. You can literally go on YouTube and say, I have a real estate fund. You can invest with me as little as 25,000 a share. From 25,000 to 150, I pay you 6% per year. 250,000 to millions, I pay you 8%. If you give me over $1 million, I'll pay you more than 8%, and we can work something special because I have that exemption and that allowance for me to do it. And then all of a sudden you can publicly solicit and show the deals you have. You can literally make, like I train people to do a 10-minute pitch and they film it. And then when anybody they can talk to, they meet in a party, at a restaurant, anywhere where there is a gathering, they tell them, what do you do? I say, I raise capital. Oh, really? Tell me, what do you pay? Let me send you a little video of 10 minutes. And the video, I did the presentation. It has my properties, how I'm diversified, what kind of products we do, what kind of projects, and the positioning we have and the profits we pay the investors. And that has changed the country. From 2015, you can look statistically to now, the bonanza has been unbelievable. Now, a word of caution, 2015, 16, 17, 18, 19, 20, 21, I mean, it was a little bit flat during COVID, but 2021 was a bonanza.
Yeah.
2022, when the interest rate went up, those who had real estate funds that are debt funds are the ones that now devouring the market because they were set up right and the money is in the structure. Mm-hmm. So I think there is a very strong positioning for those who know the business, like brokers, real estate investors, who are working with their own time, energy, money. You only have so many units of time and money and credit, right. But you set up the right structure. All the people that you helped them make money in the past, you can now have them help you and you together make the money. It's just, you create a bigger pie.
Yeah.
That's why I get excited about it.
Yeah, it's an exciting thing. I think, as somebody that's an investor, I get so nervous when I start hearing about so many people were doing it because I know what was going on 2016, 2017, 2018. It was so easy to make money that people were just throwing money at every deal, right?
You said it, yes.
Trust me, the phone was ringing. They were calling, hey, do you want to do that? Actually, they still do. But, it's finding the right people to invest in. So I think that is something. What if I'm thinking about investing in a debt fund? What should I be looking for?
So you should look what type of assets they get involved in.
Right.
All investing starts with the assessment of risk. So a debt fund has a good positioning, which is there are more than one asset. You're not just investing in one storage facility or something. So if there is a hurricane in that area or there is an issue with the market or something, that's it. You're stuck with this, syndicator who did it. In a real estate fund, I'll tell you, for me, I look at 6 things. When I invest the money, I look, number one, for safety. So safety comes from a lot of things. Number one, the location, the type of asset in that market, the condition of the asset, what we're going to do with it. So safety is number one. Number two is the cash flow. Now, we are not Warren Buffett who says rule number one, safety, rule number two, look at rule number one. Now, Warren Buffett does not pay any dividend, does not pay cash flow. Right. Berkshire Hathaway, you can look it up, for 40 some years, never paid a penny in cash flow to investors. You just buy his shares and he makes the cash flow and reinvests. Mm-hmm. But we are in the fund business, people invest with us because they want cash flow. So number one, I look for the safety of the assets I'm in, that market, what the position, okay. Number two is the cash flow or cash out. Am I rehabbing this San Francisco property that I bought for $3.8 million and I'm going to expand the basement at $500 square foot, but on my exit, I'm going to get $2,500. So I'm going to make $4 million on this. There is plenty of money to pay the investors, etc. And then I'll cash out. So either cash flow or cash out. That's the second thing I tell my investors, compare this to any other fund. Number three is liquidity. Can we sell fast? Can we borrow some more? Can we reposition the property and refinance and cash out? You see, so this is important. Is there some liquidity here? Number four is cash reserves. Do I have enough cash reserves? I have cash reserves when I borrow from the banks. We do reserves with the banks, gives me better rates and gives me peace of mind. Also, cash reserves help me on a dark day. All of a sudden, COVID hits, but I had a couple million in cash reserves. We had no problem the first 90 days. Then our tenants started paying again, but we had plenty of reserves. I didn't panic. Also, when it comes to cash reserves, when you have cash reserves and somebody comes to you, hey, Joe, I know you're a fund manager. I want to sell my property fast because of whatever, maybe a good opportunity somewhere else, maybe a distressed situation. Now you have the cash reserves. You can jump on good opportunities.
Yep.
So that's number four. And number five I look for is what I call diversification, meaning I am diversified. I'm in San Francisco, diversified by location, also in Sarasota, Florida, and also in Puerto Rico, the old San Juan area. I'm diversified by type of assets, luxury homes, built from the ground up, mixed use commercial.
Also all separate funds though, right?
No, one fund.
One fund? Okay.
One fund is, that's the beauty. It's like a mutual
diversified.
fund.
Okay.
Yeah. And the third thing, I'm diversified by style of investing. One, I rehab and sell. The other, I build from the ground up. The third, I reposition and keep for cash flow. So that's number five things I look for. And number six, I look for what is going to be my plan B. What if I can't sell it? Can I now do a lease with an option to buy? Can I carry financing? What if I develop that home and it's not selling? Can I keep it and hold it? Yes. Okay. That's why we're doing entry level in Florida, luxury homes in San Francisco. And then in Puerto Rico, a couple times, the market shifted against us. And what we did is I separated the building from the upstairs from the downstairs, and I sold the upstairs, paid off the loan completely. Okay. So I'll repeat, we look for safety, cash flow, liquidity, cash reserves, the actual diversification, and what we look for is the plan B, C, D, as many backup plans as possible. This, what I'm telling you, has helped me for 15 years, never missed a payment, and we continue to grow. And I have a great team. Of course, you build the team through the years, but
sure.
That's what
experience you want to add to that list. Check and see, how many deals have they done, how long.
So well said. Yes.
Yeah.
Even though the SEC says, when you say in my past I did this, you must say my past performance doesn't mean my future performance is good. But how can you judge anybody other than what they've done in the past, right?
Yeah. I can tell you, it's like when the properties that we sold to a guy who was willing to pay big numbers, and he front loaded everything, and he didn't care how the properties performed. So I'm a big stickler on everybody doing their due diligence and checking people out.
Yes, gives you more peace of mind. Most of the work is done before you get into an asset. Yes.
Yeah. Now you said you guys don't have a lot of fees in your funds, but what are typical funds for a debt fund?
Great. So usually in an equity fund, so let's say, well, it's not a fund. Usually in equity, it's a syndication. Right. So what happens is somebody says, I'm raising capital for this apartment building. So let's say that's the structure you want. You're going to raise money to buy some apartment building that you found that's a great opportunity that you can take to the next level. Typically, on whatever the asset price is going to be, let's say it's a $10 million asset, you as a syndicator will charge a 3% acquisition fee. So whatever money you're going to raise an additional 3%, which is $300,000. That's going to come to you. You've earned that because you found the deal, you've talked to other brokers in the market, you've built relationship, you analyzed the deal, you did all your due diligence, you did all the work an investor was trying to do, but they either don't know how, don't have the time, don't have the connections. So then you get 3% acquisition fee. From the cash flow, usually you keep 20%, the investors get 80%. Let's just put it this way. You pay the investors first 80% of the cash flow, and you keep 20%. And then on the exit, you're going to give on the upside gain 5 years later, approximately 5, sometimes 7, whatever. You're going to give them from the gains on the net profit, 70% of the upside, and you're going to keep 30%. This can make them very wealthy and can make you also very wealthy because you're going to be able to afford a team of management, experienced people on the property, and your connections and your effort and your experience will pay off tremendously. So this is, I'm not putting down syndications and equity structures. It's just not for everybody. But you can be extremely profitable because you immediately make 3%. You immediately get some cash flow, sometimes not right away if you're rehabbing the property, but you will get some cash flow for your hard work as a syndicator, and you get a good kicker on the cash out at the end. And the investors, when you cash out and they get paid, guess what they're going to tell you? Joe, can I reinvest if you have
Give
something
me more?
Yeah.
The investors in this, is it typically family offices, institutional, or just private individuals that want to invest?
Uh, Typically, it's private individuals because for
Okay.
private funds, you're going to go to investors clubs. You're going to go and now with the Reg D 506C that has been up and running for almost 10 years now, or almost a decade, you can publicly solicit on social media. You can open Facebook and you're going to see plenty of people saying accredited investors only, we pay this and we pay that. And then you can see what they're talking about and what they're doing. So the market is wide open for this.
Mhm.
But like you said, they have to do their due diligence.
Yeah.
So yeah, through the years, I've helped people with my education company. I started realizing people need to raise more capital. So I started helping people saying, okay, we're going to structure the business plan with you, which take just one phone call. We do it on Zoom. Then I have in-house attorneys. We set them up for the actual structure. And it's cost them a lot less than what they would pay an attorney who does it. And the attorneys I have, they do also litigation. So they know exactly how to structure it. And we structure it Class A shares at 8%, Class B at 6%. And then I create a special class of shares where if you as a fund manager want to pay something special, give them an equity kicker or do something, you have that flexibility approved by the SEC.
Okay.
And I even put some things like that the fund can join venture with other funds. I've had people set up a fund and they don't even do real estate deals, but they know how to raise capital. So they raise the money and they come to somebody like you and they say, Joe, I just raised $2 million. You're in the market. What can I do? And then you can say, I got this deal. Let's partner up. So they can in their fund partner with you, but all they have is the money. But you have the experience, you have the connections. They only can raise money. And this has been a huge positioning in the market that I've actually worked with people on that. And I would like to say anybody can set up a syndication or a fund. You don't need to be licensed. You don't need to have a lot of experience. You don't need to have wealth. I mean, if you have, I've had people that filed bankruptcy in the past because their businesses want this and that. They have to disclose it, but they can actually raise capital and set up fund. And they themselves don't have to be accredited, which is amazing. Right. The SEC does that.
But you have to have about what, 50 grand set aside to start it?
Usually it's about 35,000. We do it turnkey for people at 25,000 in the interest of full disclosure. But then we do the paperwork. We give it to them turnkey. We do an all-encompassing fund so they can do all types of assets. And I spend a full day with these individuals. Usually I have 2 to 3 at a time. We do it just once a month. And then what we do is we show them exactly how to present one-on-one and how to present to groups that will be in compliance with the SEC. Because there are many things that the SEC watches for, and you don't want to make a mistake with the SEC.
Yeah, you definitely don't.
Not at all.
Is there a way, I'm just trying to, where you're talking, I was trying to think about selling a property, exchanging into this. It's got to be tough or damn near impossible, isn't it?
Well, you could actually do it. The key thing is
smoke and mirrors.
The problem is if somebody's telling you, I'm selling a property and I'd like to roll all my money into your fund, that creates a bit of a problem because you have to then create a TIC, tenant in common fund. And so you front the money. And then you create the TIC so they can come in tranches, each one. And then when you sell that new asset that has so many tenant in common people because they roll the money from a 1031 exchange, when you sell it, you have to roll them all because whatever is on title has to stay on title. You have to roll them all. What if one of them says, I don't want to really roll my money. I'm ready to cash out. And well, then you have, some people don't know. They say, oh, I'm stuck now. Everybody's going to be upset because they're going to have to pay taxes. I can't roll. You can do, there's something called a drop and swap. You can drop one person out, but it gets very complicated. And when you mess with people taxes, we don't even go there.
They get very moody.
Yes, it's very true. But you know, the fund business and the syndication is very interesting because a lot of people say, I don't want to continue managing properties and getting involved. I want to sell and do this. And we can do the calculation. And I've had a gentleman from New York selling, and he said, look, I got a baby coming. I've been working very hard. I'm older. The baby came late and all this. I don't want to manage properties. I said, okay, let's calculate your taxes. You're going to pay so much in taxes. Then you're going to invest and hassle-free. No more investment, no more management, no more this. And you're going to get 8%. And he thought about it. He said, oh my God, I'm getting barely 5.5 on this one. Game, I'll pay the taxes and invest. So sometimes you will coach them through it and see what's better for them as a syndicator or fund manager.
Yeah. Okay. How are you guys when you're getting investors? How are these funds holding title on these properties?
So it's usually an LLC. So we set up an LLC and like SFI fund LLC, Secured
Right.
Fixed Income Fund LLC. That's my Reg D 506C, for example.
Okay.
And I buy the property under the LLC or MIGSIF, MIGSIF. Okay, so I buy the asset under MIGSIF LLC. The investors invested in MIGSIF. So I have several millions of my own money in the fund. So
Sure.
we put the down payment. The banks usually give us the credit line if we're rehabbing or if we're doing some work on the property or the loan. And we immediately start working and cash flowing. So we pay the investors and we make the payments to the bank. And the rest we keep. When we sell, we're out, we get the money. Now in a debt fund, you can actually have that LLC sell and roll the money forward. Like the fund itself can do the 1031 exchange.
Okay.
And then you'll be able to afford to pay the investors a little bit more money. You can give them bonuses, kickers. That's why I created that special class of shares. I'm going to tell you something, Joe. The money is in the structure.
Yeah.
A lot of people think they're going to make money with strategy. A strategy is number one. But if you don't have the structure for the strategy, you cannot grow that well. That's what changed my life, is when I figured out that I got to have the structure and do it. That was 2009. And I was with the Reg D 506B. I just was lucky enough that I had a strong database because of my education company. And I thought I'm going to raise 5 million, like in the whole year. We raised it in 90 days because I was coming out explaining to people, and I was surprised that people said, okay, I don't want to do what you do. It's too much work. Here, Cherif, here is the money. I'm going to invest.
Right.
And then they reinvested. So in 2015, it got better and easier. And today, anyone with good experience, anybody with good connections and proven track record that goes out there to the old clients or connections and say, this is what I have now, would you like to join me? Or do you know someone who would join me? Just as simple as this, like having lunch with somebody and say, well, tell me more. And now you can tell them it's a no-brainer.
Yeah, it's an easier way and less risk. So it seems like it'd be a path. Now, how many funds are you guys running right now?
I only had 2 funds in my entire lifetime. The Reg D 506B, because it started like that, and then the Reg D 506C when I can publicly solicit. And the way I structure them is what I structure for the people that come to structure with me. I show that they can partner with each other, because you can set up both.
Sure, yeah.
And you can actually expand, and you can do what's called fund of funds. For example, I've had people that raise money and then they can't find a project. So they say, listen, I just raised money and the investors want to get paid. So I say, okay, they can join venture with my fund in some deals. So we're able to show that we're co-sponsoring on some deals. So they can show their clients what they're doing. And then as they raise more money and deploy it right away in increments, now they have like $1 million, 2 million raised, they can call their money out from the partnership and they can do their own deals. So it works for me because I get to use their money, but anybody can structure it the same way. And it works for them because now they have the credibility of the proof of funds for a lot of money, and they can actually go out there and get big assets. I mean, it's just incredible once you understand that everybody feels uncomfortable, like, oh my God, I'm gonna raise money and be managing other people's money. I don't know if I'm at that level. Well, guess what? If you look right now at Dallas area, if you look in Orlando area, who is buying? The funds, private funds and big funds that are BlackRock and all this went and bought all North Dallas a few years ago, all the rentals. So if you're not a fund, you're gonna get squeezed out sooner or later. It's just the name of the game. They're changing real estate brokers commission. They're changing the bankers now. They're telling me I prefer a fund because I can ask for 5% more down payment. I have less risk. I'll give them the loan. An individual asks like, what if he dies? What if this happens to her? So it's the way to go.
Now, to find, it's great you got to raise the money. Now you got to spend that money, right? I hear these people raising $100 million, and that just gives me anxiety. I'm like, how are you going to spend all that right now? Because you have to. So how do I go out and find somebody to give this money to? Okay,
so this is where the connections and the experience in market makes a lot of sense. Plus, what I do is I create diversification. I call it the all-encompassing fund. So when we set up the fund, most people say, we're going to do some lending, or we're going to do some auction purchases, distress sale. You want to set up a structure. Like I have a structure that say we're going to do residential and commercial, tax liens, tax deeds. We're also going to do some lending based on these criteria. So I create what's called an all-encompassing fund in the US and in US territories. I set up this gentleman just the other day. We set up everything and we just finished the training with him. And he's from Canada. So he found out he can set up in the US. And he was doing lending. And I said, you know what? You're getting money from others, loaning hard money loans at 15%, and he gets 3 points, etc. And I said, but you're selling these loans and you're just making 3%. He said, yeah. I said, what if you raise the money at 6 and 8%? Let's say you raise it at 10% because you're very generous. Now you raise the money, you're loaning it at 15, you know what you're doing, you're an experienced broker. You're gonna get 15, pay your investors 10. Blew his mind away. Now we have just finished the paperwork. He was sending me an email the other day. He said, I already have 5 million lined up from people that were looking for somewhere secure to put their money.
Right.
So, so that person, if he raises 100 million, he can do loans, he can do some purchases because he can foreclose on some other people that did loans and didn't foreclosure. So I never want to raise more than I'm comfortable with. Like people tell me, Cherif, why don't you go for $1 billion in assets under management? Why? 150 million and go take a cruise, you relax, I got a team, I'm diversified, I walk the talk.
Yeah, when I was 20, that might have sounded good, but now I'm like, you know what? Let's just not take off too much, and just enough that we can chew it and digest it. And
Joe,
because having to spend that kind of money, that's people don't realize.
Yes,
that's tough to do.
Yes, they wanted to impress everybody by coming on Facebook and saying we're almost $1 billion in assets under management. Why the stress? Yeah. Maybe some people are structured to be able to have that level of stress. I mean, I always ask people, what would you do if you get $1 billion? You just want $1 billion tomorrow. What are you going to do? And they're like confused. I said, well, then you look for bigger assets. You look for the large hotel that you can buy from Hilton and have Hilton manage it. You see my point? So there are structures for the size you have. I like the 100 million in assets because I have my own portfolio, which is substantial enough, and I have a team of people. Now, I don't want to add more people, and I don't want new relationships. It's kind of actually boring. My business model is kind of boring, but my vacations are very exciting.
I can imagine. Heading to Puerto Rico wouldn't be too bad. How big was your first fund?
Well, it was the first fund I started. It's the one I continued, because when you set up a real estate fund, you don't have to have
it doesn't have to end, right?
Yeah, you can literally say, anyone who want to cash out, you can cash out. Anytime I want to refund you and cash you out, I'll cash you out with accrued interest. But when I started, I was thinking I'm going to raise 5 million.
Okay.
And that's I thought like 5 million is plenty because I was already doing a lot of money with several millions of my own money. But when I raised the 5 million, I realized I'm just deploying the capital right next to what I'm already doing. So I said, they want to give me more money. Okay, let's take more. And it just helped me grow. And that's when I realized the diversification will give me more peace of mind.
Sure.
And then when we got solid in what we're doing, we started growing and growing and growing. And I always tell people, focus on an area, focus on a specific type of properties and understand the values. So when a good deal comes, you go from being scared to being excited. You want to do it. Yep. And that's the system,
that everybody has to remember that real estate is extremely local. If you've got an apartment building in one area, you go 2 blocks down, it could be a completely different area.
You're so right. We were talking. Yeah, we were talking before, you and I, about single tenant buildings, etc. In a single tenant building, a property in the middle of the street does not have the same value as the one on the corner a block away. This is unbelievable. This one gets 8,000 a month rent, but this one gets 12,000. And you got Starbucks and McDonald's fighting for it. Why? The drive through, the corner thing, the visibility, etc.
Yeah.
Totally.
Yeah. We've got one in Dallas, signalized intersection. And it's actually dark right now. We bought it, and it was they were going dark in about 2 months after that. We've got 6.5 years left on the lease, so we're looking for somebody to go in. It's an old Chase Bank.
Yes.
But yeah, it's the value we're going to get once this is all done. We'll take a buyout from Chase Bank, and maybe, we don't know. We're looking at all options. So yeah, we've got a lot we're working on. And
I did a buyout with Burberry one time that was, they got all excited on a location. It was a corner property. And it was a 15-year lease. A year and a half into it, they gave me a call and they said the CEO decides to grow in China and we don't want to grow in the US at this point. So we want out of the lease. But you have the corporate guarantee. And I said, okay. I had another tenant called Perfumeria at the time. And I said, okay, you got to pay me $1 million because you signed for 13 and a half more years and it was 20,000 a month. And to my surprise, no negotiation. They just want it out so bad. After remodeling, they paid it.
Yeah. Yeah. Why go through the hassle with the attorneys? Pay it and move on, and you can take that money, do the build out with the other tenant, and away you go again.
See, that's a course of experience, right?
Yeah. We've been doing this a while. You said one thing I wanted to ask. I know you got to go. We're getting a little long here, but is if somebody pulls out of your fund a little bit earlier, there are prepayment penalties if they say, you know what, I don't want to go any more years?
No, not at all. We cash them out within a 12-month period, and when you are a debt fund, you can refinance a property and cash them out.
Right. Okay.
When you are in equity fund, you refinance, you have to pay all investors equally, proportionately, etc.
Yep.
Also, listen to this, when you're a debt fund, you can literally have somebody cashing out 400,000, but you have another investors coming at 400. This one substitutes that one. You cannot do that in an equity fund. It will be a Ponzi scheme. But the SEC says we don't care in a debt fund. You don't have to sell assets. You can cash out through refi, selling a property, or raising capital from somebody else. It's like you have a loan with Wells Fargo. Chase offers you a better deal. You can refi. We're cool with that. Let me tell you, I have a lot of experience with SEC. I've been through audits. I've had students/investors who had audits, etc. And I became an expert in the field. That's why I help people set up and give them the all-encompassing fund, and then give them the exemptions within the exemptions to be able to pay investors different based on the assets they have, and help people stay within their comfort zone, because you become very good when you manage other people's money, and you don't want to go outside that comfort zone.
No, you don't want to get the phone call.
You don't want to get that letter. Yeah. Yes.
Yeah, you don't want to get it. Well, Cherif, thank you very much for all this information.
Yes,
I think let's get you back on here in the next few months and continue this conversation. Okay. And thank you.
Thank you.
For those of you watching, make sure you give us a like. And if you haven't done so, make sure you subscribe. And just so you know, I'm going to put Cherif's contact information down below.